This is the In Focus podcast from The Hindu.
Hello and welcome to the Hindu's In Focus podcast. I'm Nivedita V. Artificial intelligence is changing the way finance works in India and across the world. Banks and fintechs are using artificial intelligence for a lot of things, from fraud detection to credit scoring. With that comes a lot of new opportunities, but then there are also a lot of risks involved. There's a risk of bias, there's the risk of privacy, there's also issues like cybersecurity, which banks and fintech institutions have to take into account. So this is why there is a Reserve Bank of India recently released a report called Free AI, or the Framework of Responsible and Ethical Enablement of AI. So what this report actually does is that it lays down 7 guidelines, sutras as the report calls it, and it gives 26 recommendations on how to use AI in the fintech space. The idea is a great idea, but it's a simple idea. How to encourage innovation while keeping all of these risks, which I stated a little earlier, in check. So the big question we are asking today is, what does this framework mean for India's financial sector, and how can the RBI use regulations to keep fintechs in place and also keep the customers, the end customers, safe? To answer these questions, I have Professor Prasanna Tantri from ISB. Thank you, Professor, so much for joining us today.
Thank you. Thank you for having me. Thank you so much.
Let's start off with where exactly financial institutions use AI. So they use AI for a lot of things, from fraud detection to how a person's credit score is calculated. Can you give us a little bit on how banks and financial institutions use AI?
Yeah, I usually joke in my class saying that the biggest fintech in India is SBI and not many fintechs. They do use in number of in number of cases. For instance, there are banks which have a 1-minute loan approval window these days. They have these rule engines. You input data and immediately that checks everything and gives you a decision whether to give you a loan or not. From there to things like call centers, today there are a lot of responses are a machine is giving you a response. Of course, also to detect a particular transaction, whether it is fraud or, in fact, we are working with the bank where they have this problem that, they want to detect fraud. And the current algorithm they are using has this problem of false positives. False positive is it is unnecessarily tagging everybody as fraudulent. Imagine, every small 100 rupee transaction you make, you get a call from, you sometimes you do get call, right? When you make a payment abroad, all of these, there are, and robo advisory, why not only this, there are investment firms where portfolios are created. Robo advisory exists, there are studies on that, how do they do versus human beings. So there are a gamut of things, and then process improvement, obviously, like any other, from HR process to operations to purchases to all kinds of process improvement, which the way the Hindu may be using, a financial institution also uses. So it is getting used in a wide variety of spectrum of applications within finance. And so it is there, but it is not as if it has taken over or has become the predominant. This is for small cases, standardized routine kind of cases. We are still to reach a level where it starts replacing, say, loan officers or things like that. We are nowhere close to that.
So that's in regard to India, where AI is not taking over the jobs of humans in, say, as you said, people who disperse loans, but AI has already started taking jobs in like chatbots, like you said. So how is it compared to the world?
Yeah. So with respect to this particular area of technology digitization, in fact, India is not very behind the world. In fact, as you know, in many cases, we are ahead. Payments, especially, we are far ahead. It's far easier to make payments in India than any other place in the world. It's not that straightforward. Moving money is not a easy job, as like we are used to this pay, that pay, phone pay, Google Pay. These things don't exist elsewhere. So when it comes to especially digital technology in finance, digital technology in general, we may be behind the rest of the world, but digital technology in finance and some administrative reasons, we are not way behind. So it's not very different in rest of the world, because as we maybe, I'm sure you will ask, there are inherent limitations. Beyond the point, it is not a structured decision always when it comes to finance. So you can't, as if the decision is very very unstructured, and then the consequences are terrible. As we know from 2008 crisis, attempts to make finance programmatic, mathematical, rule based, have resulted in disasters. So people are aware of 2008 is not not like 50 years ago. So people who were at the helm in 2008 are still around. So people do have these memories. So therefore they're careful. Because 2008 was not AI, but it was a it was like a quant revolution in finance, where people thought by mixing stuff, the correlations, and you can reduce risk. And with two bad mortgages, when you combine, the risk goes down and things like that, which sounded very good on paper, and which you could prove on paper, and then what happened. So people are a bit careful. So I don't think even globally things, it's not that finance companies are being run by machines. That's not the situation yet. People do
So,
take judgment calls.
compared to 2008 to now, there's a lot more risks involved because we are using AI. So, we already saw how overzealous, let's go with the word overzealous, input can do. So, how risky overzealous play can affect not only one country's financial systems, it can affect a whole lot of countries, like we saw in 2008. Given AI is something that we can't control on a day to day basis, how much of a risk is there in the sector now compared to 2008?
Yeah. So we had our own mini version of that, because it was for small segments. So we don't, it did not become such a big crisis. So 2022 to 24 in India itself, if you see, suddenly credit growth picked up. It was driven by NBFCs. Just look at household finance data in India. Now the household savings rate has fallen by around 3%. Debt has gone up, and it is not. And then we realized it's not that constrained people are given credit. Basically, many of these AI, so-called fintechs, created their own. I'll tell you, there is structurally what their problem is. They created their own algorithms, and anyone, for instance, if you have an iPhone, you are a good person. If you have this, they created their own rules, so-called alternative credit scores, and started lending left, right, and center. And this was fueled by VC money. Good thing is they did not use depositor money. You and me were safe. There were VCs who were happy to finance immediately post COVID, and half of the fintechs are shut. You don't hear their names; they are gone. So India itself had its own mini version of that crisis in the last 2 years. Now things are stabilizing a bit. We went through a high unsecured loan default cycle very very recently. So this was driven by, if I may use, overzealous application of technology. So people don't get this thing right. An algorithm created using your data cannot be used to give loan to some totally new to credit person. The input output relationship that applies to you is very different than an input output relation applies to a student. For example, you buying an iPhone versus some unemployed person buying an iPhone to impress someone. You use that iPhone buying as a input in your algorithm and start predicting default. You buying an iPhone may indicate that from business line you come to Hindu, and you got a promotion, whereas some unemployed person is trying to just show off or borrow from some place, and buying an iPhone. And if I learn from your behavior, okay, after you bought an iPhone and you started repaying better, and then I start giving loan to everyone who buys an iPhone, then it will be a disaster. This is what many of these fintechs did in India, because this is called selective labels problem. A lot of us in finance worry about it, that a lot of these new people who come in because of these fintech algorithms do not have outcomes. They only have inputs, and you're using somebody else's outcome on my inputs to learn about my behavior. Your sort of assumption is input output relationship of mine and yours is the same. It may not be. So financial inclusion, as you said, that RBI document is a great document, but when they say this can be used for financial inclusion, it doesn't. Number of people without formal credit hasn't come down dramatically. It's still, if you see World Bank Findex database, although technology has improved, savings account has improved, giving credit is not that straightforward. And whenever we have tried to randomly give credit using some algorithm, it has usually resulted in higher default rate and a regulator coming after these people, shutting down some of them. And so that way, while it's a great tool for process improvement, call center, risk management, and all that, but for lending, investing, and we are still not reached a level where it can do better than humans.
So, as you were saying, my input can't determine your output, right? So, how do the fintech determine this right now? Have they fixed it?
No, they have not. So, in fact, they should do experiments for that. They should go to a VC. Unfortunately, they don't. And I've tried speaking to a lot of people. They think algorithm created in Bangalore can be used to lend to in Lakshadweep. That's the problem. And see, last 2 years have been, not last 2 years. Six. If you take last 2 year, 22 and 23, maybe beginning of 24 have been very good. VCs never ask these questions. What happens when VCs become exuberant? They don't ask questions, they give money on a particular sector. Like before that, it was edtech, and after that, fintech. From tulip boom to that is how has been the story of humankind. So they didn't ask questions. These guys had sort of free money and they started expanding. And now the default rates have gone up. So what they do is two things. They will not go into that segment which does not have credit. They will start lending to safer segment, you and me, who already have access to credit. Then it becomes more competition to lend to same people, skimming the cream. It's the same people who would have anyway gotten credit get from fintechs also. That's like an increased competition, which is good for consumers. Or the other option is some of the fintechs have started making secured loans. It's so ridiculous because whole fintech is supposed to be based on information. Information is a security, and if you ask for collateral, gold, the worst part is gold. Gold is a currency. You are asking for one sort of currency to as a security to give another sort of currency. So some of them have moved to that level, but some of them are good. I don't want to say everybody is like that. Some of them I think have figured out, have good algorithms. See, and it's not pure play fintech, right? I think SBI uses more fintech than fintechs. Some of the fintechs are, these are ex-bankers. They understand the market. They know how they have this so-called soft information. My theory is they are not using fintech. They are using these founders' knowledge of the market, and they know who are good and who are bad, and they're lending that. So that way, it is not pure fintech. It is a combination of use of soft information and technology. For instance, if you know that anybody who changes phone number repeatedly is a bad guy, right? Suppose you know it. Now, that's not fintech. Nobody has tested it. This guy knows that if you frequently change. So there are rules of thumb. Many of them who have succeeded, in my view, they use rules of thumb and not, and it's sold under the garb of fintech. This is not AI discovering. See, AI is like, there should be some pattern which the machine should discover. You and me should not know it, right? It is not that. This is like what you and me already are biased. For instance, one particular area, everybody is bad. Somehow we don't like that area. So whichever application comes from that pin code, we don't lend it, right? We don't lend to particular category of people. So our own biases we have fed into an algorithm. Sometimes it works, sometimes it doesn't. I think that is what is going on in the name of fintech, but not a true fintech. That's why I repeat, there is one organization where it is true fintech, which is SBI. That there you feed in, it will give you a rule.
So, is the problem with fintechs right now is that they don't have a large enough sample size?
Absolutely. Not only not large enough sample size, they don't have the right samples. So they should do experiment. I know it will sound academic. If they should go to a VC and say, hey, look, if you want me to create a new algorithm, lend to this large mass of people who do not have a loan, this is a big opportunity. These people are borrowing from money lenders at crazy interest rates. We can tap them. So, but I need to know outcome. I need to know how will they behave. So for which, give me like some 10 crores, 50 crores, which you're willing to lose. This no underwriting. It should be a totally randomized stuff. I'll pick up some 10,000 people and I'll lend them randomly without checking. Once you make that, then collect input information about them. Now you know who's going to default, who's not going to default, because this sample is not selected. Then create an algorithm, and once you have an algorithm, then start lending to everyone. This step is completely missing. Nobody is willing to lose that 10 crore or first 10 crore or 50 crore, but they're willing to risk later 1,000 crore. That's the funny part. If you're not willing to this 50 crore, you should be the VC, or everyone VC who is giving 1,000 crore should give this 50 crore, where 25 crore 50% default rate is possible. Fair enough. Because there, among the people who don't have credit, there will be bad credit, there will be good people who don't have access. So the whole idea is, how do I separate these two? And this, right now, we are using through our own biases, our own, sometimes what is known as experience is nothing but bias, or experience. Sometimes both are, or soft information, what you call. These are very hard to separate. Sometimes soft information, bias, experience, sixth sense, whatever you call it, it is very hard to disentangle these things, and which we ourselves are fed into an algorithm. So unless we do a scientific RCT, a randomized control trial, for which if you are willing to lose money without putting any filter, the worst part is, I've tried doing an RCT with a lot of people. There also they want to put some filter. If you start putting filter in a experiment, then it's not giving you right thing. So unless you do that, this financial inclusion is not possible. You don't know who is good and who is bad. You will start losing money. Default rates will start going up, and moment default rates start going up, RBI will come after you. They will increase risk weights, and then you're shut down. And some of them will survive, remaining will do secured loan. That's the story all over the world.
So that will be uh, giving banks, the major players, a lot more heft to do this, right? So if a small VC, me sitting here in Chennai, can't go to a VC and be like, give me money for me to do a randomized survey, and we'll see what happens after that. But not SBI, but a bank as big as SBI can leverage, can take in some of the losses if there are losses from this, right? So how, or maybe even the government, for example, can take, not that the government should come and give out loans and go and do fintech for the people, because they have other kind of fintech to do. So
Right. I'll tell you two, three actual solutions. One is, I think the smaller players are at an advantage because SBI has its own rules. It can't randomly lend. It will require 10,000 permissions. But in your own firm, small, if you can convince a VC, you have to make a case to a VC that your algorithm is going to be different. If you can, you can. But let me tell you two actual cases where there is ready-made experiment. You don't have to do anything. One is self-help groups. There are crores of self-help groups in India. There are at least 10 crore women who borrow from self-help groups. Telangana alone has like 40 lakh people who borrow from self-help group, SHGs. Now, what happens in self-help groups is that this is a group of people. The group borrows from the bank. It's like an organization in itself, and then group distributes within the members. Now, this thing is not recorded. Now, I give it, let's say 10 of us have created a group. While my group's transaction with the bank is recorded, within group transactions are not very well recorded. Now, if you can work with some groups and record these within group transactions, you can create, study who repays who. Anyway, somebody is doing an experiment for you, and the good ones among them are, then you can, that's one place where you can get algorithms for those, because these are, if you go to credit bureau, they're considered new to credit. Why? See, imagine a woman who has repaid 10 loans non-stop last 10 years, hasn't defaulted at all within the self-help group. Because her transactions are not recorded well, she is considered new to credit. She goes to a bank today, no credit history, 26%. That's what she has to borrow. Now, some fintech can get into these groups and get this recorded, identify good people. I think you will get lakhs and crores of borrowers, totally new, no competition. And because currently they're being charged 26%. Even if you charge 17%, you can make money. These are good borrowers, they don't default. That's one place that they can enter. The other is the government. You said government, right? There is this scheme like PM Swanidhi, for instance, street vendors.
yeah.
This is an ideal experiment. They randomly lend to everyone. So because they randomly lent, now you study the performance there. I have created an algorithm based on PM Swanidhi. And what if, and lenders are using it. What I'm finding it, almost 40-45% already now have non-Swanidhi loans, because somebody is seeing this performance and started lending. So look for these opportunities, start from there, go to a VC, make a case based on that. I'm sure VC will agree for a larger, for an experiment. Another related point which I wanted to make is the entire banking system. Another issue is, making a loan is one. The algorithms fail to identify who is likely to grow and who is unlikely to grow. Repaying is one, because if you can predict who's likely to grow, then long-term relationship to total your profitability also increases. So I think the fintech should not shy away from experiments. These are startup tech types. If you're tech, then innovate. Without experiment, how will you innovate? And there is risk, of course, when there is and I think if we make a strong case, there will be funders.
So you mentioned the algorithm, but the algorithm is various algorithms for various institutions, right? Every single fintech player will be having their own algorithm. So with that, there'll be concerns of bias, like we were talking about earlier, or there'll also be issues with how the AI is using the information. So how is the RBI? We're slowly coming to RBI here. How is the RBI tackling this? Is it tackling it right now?
No, so right now, as the report, see, the report that you cited is a committee of experts. This is like a recommendation. Right now, RBI, I don't think even audits the algorithm properly. What your algorithm is and all that. Forget about finding bias and all that, because that requires tremendous capacity at the end of RBI also. It requires a lot of resources for them also to sit and do it. As I said, many of them are not pure play algorithms. There is human judgment. Eventually, algorithm is a recommendation only. There are these people don't just lend. Algorithm says they lend randomly. That is very rare. Small ticket loans only, not large loans. Yes, as of now, I don't think there is any mechanism to see whether there is bias. There is mechanism to see. Of course, if it is very blatant, then it's obvious. You can see the portfolio and figure out. But if it is not blatant, for that there are a number of studies, right? Suppose you want to check whether an algorithm is biased towards women. So what you do is, from the algorithm, remove that gender identity, right? So remove gender identity and ask for recommendation from the algorithm. Now, once you put the gender identity, will it increase your risk score or reduce your risk score? Just because you added a gender identity, if it starts everything else being the same, it increases your risk score. That's very clearly, it's saying women are bad credit. Let's say, if these kind of tests can be done with algorithm, but that is in a world where people are lending only based on algorithm. My problem is they are not. So when we move there, I think RBI will have to worry about that. Right now, we are not nowhere close to that. But there are a number of studies.
Let's talk about what the RBI is saying in this report, and then we'll talk about how good the recommendations are and how they can be implemented in reality. So, what is the RBI saying? What are some of the 26 guidelines that the committee is proposing?
Yeah, so the thing that I like the most is about data infrastructure. That creating a data infrastructure, I think, is a necessary first step for any kind of fintech application. Right now, the problem is, if I want to launch a fintech lending to the poor, what input data I use? Where is the data about anything other than they don't have credit score, they don't have income? So there was a proposal in the budget few years ago. The idea was to create an information bureau about those who do not have credit history. Now, what it could have data on purchases. So state itself has information, let's say, on things like electricity consumption, fuel consumption, things like that. You can create data sets, digital transactions, savings account transactions. So I think idea to create a consent based data repository which can sort of be used as an alternative credit score, I think is a great among all the recommendation, that's what I like the most. But then I warn, my warning is that that doesn't still tell you about outcomes. Right now we neither have inputs nor outcomes, unless you do experiment. Otherwise I won't know how that data predicts loan performance. For that I need outcomes. I need to give loans. If I don't give loans, I don't know what is the how that data will, then I'll be using somebody else's, those who all people like you and me's input output relation to predict for those people, and then we'll mess up. Then we'll have a crisis. That I think is this thing. And the second thing is about consent. Now this is a double-edged sword. Of course, as a fairness, we should take consent. It's all right to say about consent, but consent brings in selection. Now you can't have both ways. Moment you bring in consent, right? Question comes like, we have open banking in India. You have these account aggregators, right? Account aggregators can take all your financial information and give it to prospective lenders, provided you give consent. Now, this is where, as a researcher, while as a citizen, I love this, but as a researcher, I have a problem, because I don't know what type of people are giving consent. I can't
Only the
use it.
people who know about it will give consent. So there already some level of education involved.
Maybe, or this is a problem, then I have to make assumptions, who will give consent, because I'm an empiricist, I have to test unless I see the data, so this is a problem, then it becomes a selected sample. Then you can't run a scientific experiment if you put a filter. Now that's the conflict. I was thinking at least the report will talk about that. See, economics is all about trade-offs. One is to ignore the trade-off, other is to say, look, there is, if I tax people, some people will be worse off, some people will be better off, but I'm okay if these people are better, those people are slightly worse. I want, that's one way of argument, where at least you acknowledge the trade-off. But if you don't acknowledge the trade-off, then you will be in a shock. Because then my worry is, suppose you have a you create all this data for those who give consent, and as you said, these are educated people who understand and all that, they start giving you consent. Then you can't use it for the uneducated and those kind of people, because their this algorithm then becomes not so useful for them. So the there is no other option than to do a randomized trial. And if you put consent, then there is a problem, then the algorithm becomes problematic. So that's,
So
there is no
sorry
easy
to
solution to
interrupt you
this.
here. So when you say a randomized trial, we've been talking about this for a while. It just occurred to me. Randomized meaning, so you just call up a person and be like, "Hey, here's a loan for you, and you have to repay it." Is that the random trial that you're talking about, or are you just speaking from
Yes,
anyone who might
yes,
need?
yes, yes, yes.
Are you just speaking for anyone who might need a loan? Is that the random trial? Which is the random trial? Because one of the other can mean totally different things to totally different people. If I don't need a loan, if somebody gives me a loan, I'm going to be like, no, thank you, right now, right?
Great question. You are pushing back. I like it. I tell students to please push back like this. Professors should not get away easily in class. I am talking about the former. That's where it's so difficult. That is why PM Sonidhi is a golden experiment. You know what they did? They went with the municipal officer literally to a street vendor and said, "You take 10,000." And the guy said no. Even the somebody who said no, 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 you take. That's why they took this municipal officer. And then they said, "Look, I'm going to give you this card, street vendor card. Now, at least for that sake, you take it." So that is the ideal thing that I'm looking for, where I don't have any kind of selection. I get everybody as a loan. Now that is not possible. The government can do it. Then I have to put a gun on your head.
So
So
will they be forced to pay back the 10,000 rupees? The 10,000 rupees they didn't want in the first place.
yeah, they may pay, they may use, but at least I learn about such people also, because I that's an algorithm for all. But even the second one that you said, that is not practical. The first one, although is ideal, it's not practical. You can't do it. How will, if you don't want a loan, how will I give you a loan? But even if we give a loan to those
Force
who
it on
want,
me. You
because
say
those
you
are the
have
people.
to take it. That's the only
No,
way you
I
have to
can't
do
do
it.
it, so leave it. Yeah, yeah. No, that's not possible. Let's leave it. But even the other, see what is. I'll tell you what. Let's understand the economics here. What is the, why are we? Why am I harping? Although you didn't use the word, but I think almost you felt like that. I feel, RCT, RCT. Why am I harping on that RCT here? Is that, look, when a new applicant comes, why, when do you need a fintech? You need for a new applicant. New applicant comes, you should be able to take a decision using an algorithm. Now, new applicant need not necessarily be similar to your existing borrowers. That's the problem, right? So if you want to study new applicant, it's not bad to do an algorithm based on those who want a loan, because this guy is also wanting a loan, and those your algorithm has learned about all who need a loan. The only thing, you should not have a filter. You should not reject them saying, "Oh, your score is bad, your this is bad, and that is bad." Just study everyone. Give loan to everyone. Whoever says, "I want a loan," you give it, no questions asked. Whether they may misuse, they may go to liquor, they may do whatever. At least that's what I want to learn. Who is going to use my money for liquor? Who is going to use my money for productive investment? Who is going to grow? To way I learn is give, test and see that. That is more practically implementable. And with open banking also, the problem is you will have data only for those who give consent. Now we don't know who gives consent. I'm working on a paper on that, but right now we don't know that. So these issues, if you don't address, they don't go away. You will have nice frameworks, but it won't lead to anything.
So, but the issue of consent is of utmost importance in India and around the world. We're talking about data privacy, data protection. And in India, where we don't have enough knowledge, even among, I would say, the people, the so-called educated class, about data privacy, everyone just reads, clicks I have read, and then goes through whatever site they need to go to. So how do we balance the issue of privacy concern, especially when you're trying to study something or use a person's data in something as opaque as AI?
Credit bureau, for instance, you are already giving a credit score, you're already giving data, your data credit bureau knows, right? So there is no question of consent anything, whether you want to borrow, you have your loan performance goes, right? There is absolutely no question of consent here. So the thing with credit bureau is it won't tell you which loan you defaulted, what you did, it will give you a number. Similarly, you can have a information bureau which is created by the, although the committee does not use the word, but they almost hinted that, create an information bureau where you don't tell that, someone has so much insurance or something. Have a, create a kind of a score, alternative score. That testing will require some participant, like in drug trial. Don't you use people voluntarily risk their own lives for drug trial? Don't you do that? We use RCTs for far more serious things, and people risk their lives while, during COVID and all. So you need that many volunteers willing to sort of sign up, randomly selected. Once you do that, once you create a score, then I will not reveal your savings account transaction is so much. I will only say your alternative score is whatever 900, like the credit score. So that kind of a compromise, if society is not willing, I am okay. See, as an economist, I am fine. Don't do the compromise. Then you will not have a fintech system. Your poor lady will not get credit at 16%, 14%. She will continue to borrow at 26%. There is a cost to that. Our job is to point out both sides, trade off. Then the society, let the society figure out what is right, what is wrong, and who are we to judge. We are not interested in giving milk, and the first class of economics you would have attended, the professor would have said, we don't care about milk and alcohol. We'll say alcohol will give this, milk will give this, now you choose. All that I'm saying is, if you want a good algorithm, it cannot be selected. It has to be based on representative sample, and then once consent comes in, this is gone. Then you don't have a sample, and then as good as not having it. I want you to, because you do podcast, right? You want to talk to fintechs and ask them how many of them actually use GST data, this data, and go and check their algorithms. I have spoken to like 30-40 of them. They don't use at all. They don't use because where they need, they don't get consent. Where they are in doubt, see, where do you need this alternate data is when you are a little bit in doubt about your credit history. There, if you don't get consent, what is the point of getting consent for someone whom you know very well that is either very good or very bad, right? That is where the problem is. So the solution is to set up an information bureau like credit bureau.
Okay, so moving on to what the RBI is saying. So, what is the RBI saying when it comes to regulating AI? So, this is the first time that they have actually set out a report to monitor, to tell fintech companies and banks, hey, listen, we want you to regulate AI and we want you to regulate it. We want you to use it in such a way that it is useful to you and to the public. What is the RBI saying in the report? The committee saying in the report?
Yeah. So there are things like, see, they have the 7 sutras, right? One is, some of them are, people first, innovation over restraint. For example, innovation over restraint. This looks like, they are, again, what is that innovation? Again, as I said, right, I am all for using this for processes, from HR process, you want to simplify, recruitment, you want to simplify. But then that is not any different for finance and non-finance. Anybody can use. Call center, you want to simplify. But do your core job, can you use this for lending? Can you use it for investment advisory? Can you use it for any of your core job that you do? Is a question, right? There, I don't see any recommendation saying anything other than urging RBI or governments to create this data repository, but then that is consent based. So otherwise, they're talking about responsible use of data, fairness and equity. Again, all outcomes should be fair and non-discriminatory. These are, yes, I know this is good that, because this is a recommendation. Maybe RBI, when the actual regulations comes, they will have an audit of algorithms. In a world, let's say we are all lending through algorithms, maybe they will look for discrimination against particular groups, or if they have it, maybe that's that, and this discussion has happened in advanced countries and people have looked at it. Recently, there is a paper in the Journal of Finance which shows that after repeated in 10 years ago, there used to be algorithms used to discriminate, but recently they don't, because people are conscious, they have understood, and algorithms don't discriminate. So we can learn from other countries and other places. And the it's talking about accountability about data, and making it simple, and resilience and sustainability and things like that. These are like broad, nice stuff. Everything is nice. There's nothing wrong, but I think the core idea that, I think it comes in that innovation. They're saying innovation or restraint, right? I would say that is where RBI is telling these people to do experiments. You lose some money, it's okay. Maybe otherwise you can't create a fintech system. And then these 7 have led to other 26. But right now, if you see, right now there is only regulation on digital lending. There is nothing for AI, and that is on first loss guarantee. Remember 2 years ago there used to be controversy. This is the thing where you can have nice regulations. I was talking to a friend who is a lender. All these fintechs, what they used to do was, they would give a guarantee to NBFCs. By the way, there is, for your viewers, there is nothing called fintech in India. That's the first thing. There are NBFCs and there are banks, there are small finance banks. There is no category called fintech. That's why I keep saying SBI is the biggest fintech. Fintechs are some kind of agents of these NBFCs who go and take applications and bring in loans to NBFCs. That's what they do. Aditya Birlas, Bajaj Finance, and all that. And they claim that they are like tech types. They use technology. That's what fintechs are operating. So, I would start this by defining a fintech. What are they supposed to do? What are they not supposed to do? What should an algorithm have? What it should not have? How will the algorithm get audited? How do you assign risk scores to algorithm? Like your capital adequacy, right? How do you assign risk scores? What's the capital? If you have this kind of algorithm, capital requirement is this much. If you have this kind of algorithm, then the capital requirement changes, so on. Those kind of issues are, maybe this is a starting point. This is like a broader set of guidelines.
What can we understand about RBI's intent? Is it more of a is it more of a signal to NBFCs and banks and other smaller companies and institutions to say this is the direction that we need to go? And what is the intention of the RBI, given that the regulations, the guidelines that they have offered here are so broad?
Yeah, it's very broad. I don't know how it will change anything on the ground as of now. They are, for it, there is no, the problem is we have been sort of inconsistent. See, just look at last 3-4 years. Immediately after COVID, we had this cycle of unsecured lending, random lending, unsecured lending went up like 30-40%. And suddenly then RBI started clamping down on that. They realized that these loans are given for nothing, all consumption loans, buy now, pay later. Now, first they allowed, then they disallowed, then they said any loans by banks to NBFCs, capital adequacy has to be, risk weight is higher. They started clamping down. Now they are again saying people may be different. See, institution and people, we have to see the difference between that. RBI as an institution is what matters, and who is at the helm of RBI does not matter. So RBI is more of an institution, right? As an institution, if I think about what does RBI stand for, I am totally confused. 3 years ago encouragement, 1.5 years ago clamping down, now again seems encouragement. How do you how do you know that 2 years from now again there will be clamping down? And unless you tell me that, that's why I said specific, right? You tell me that next 5 years I will not increase risk weight for unsecured lending, right? So we have to take a call. If you want fintech in India, you have to be ready for institutional failure. Some NBFCs will fail, because this experiment means risk. You cannot have a system. One of the things about financial system, we want a financial system which is innovative but no failure. That is not possible. They should be prepared for some institutions going down, and once some institutions go down, they should not overreact and start clamping down on everything. Innovation. So are you going to give those kind of assurances that we will not randomly increase risk weight after 2 years when NPA rate becomes 10%? Otherwise, imagine VCs have burnt their head again. Now they see these nice guidelines, put in money, and then NPA, somebody does all kinds of stuff. NPA rate goes up, or some complaints come that these guys are looting and things like that. Then suddenly if RBI takes a U-turn and starts clamping down, then this will be a cycle. Either, so we have to say next 5 years we want to grow unsecured lending in India. We need algorithm, so many fintechs, and we will. This is the regulation. We will not change. We will not change for 5 years, and you can have a limit, right? You can make sure that this does not cross, say, more than 10 lakh crore. Our total bank loan is close to now 180 lakh crore. So some 5 lakh crore, 10 lakh crore fintech is fine. But I think my worry is inconsistency. These broad stuff, saying like 7 sutras or whatever, 15, 26 rules of happy life, and this is things like that. What does it mean? Are you telling me that if I go and lend, I fail, you will, or some people go and default, you will, you remember the two NBFCs were shut down temporarily because of high interest rate. This is crazy. You will not believe. If you have this kind of mindset, you should not be even talking about fintech. Now, they gave loans to some people, iPhone buyers and all, which when you analyzed, interest rate became some 45%. Now, the problem is when I give you a 3-day loan, 5-day loan, right? I have a lot of fixed costs. Annualizing that 5-day loan, 7-day loan, and multiplying, and you use the problem is you use an exponential function for analyzing, e to the power RT. If you go back to high school, right, it will give you some crazy number, 50%. Suppose I give you 100 and I ask you in 3 days give me 103, right? It could be my service charge, my whatever. Now if you take that 3 days 3 rupees and annualize it, it'll look like something crazy that I'm charging, right? So the risky loans means like that. Interest rates have to be higher. Now some RBI regulator sees this and says, oh, these guys are profiteering and looting and all that, and then clamp down on them, shut them down. And here in the guideline you say innovation over restraint. Now when I actually innovate, then you want restraint, right? So my worry is, in actual practice, if you come in and show I'm not, again, as an economist, I'm okay with conservatism, but tell me in advance that you're going to be like that, so that I don't experiment. Now the problem is, if I experiment and do all of that, of course, if I expand to those kind of segments, I will have to charge more. If I can't lend at 8%, the default rates are going to be very, very high. So my worry with that lack of specifics is I hopefully, after this is a broad guideline. I understand there will be specific regulations which stay for 3 years, or 5 years at least. That's the most important case. If they again want to change after 1 year after seeing outcomes, if RBI as a central bank is unwilling to take risk, then how do you expect these poor entrepreneurs to take risk? That is where the problem is.
So, but I would push back and say the entire need for RBI to be risk averse is because a lot of people take loans and they might not have the capacity to pay such high interest rates. And if institutions lend to a lot of these people at such high rates, they will fail. So the RBI has all the right to be a risk averse organization, right?
Absolutely. So I started with 2008 crisis, right? So 2008 crisis, look, that is different. India and the US are different. What happened in 2008 crisis it was mortgages, right? In mortgage, what happened was, let's say you are an ordinary American worker, and the house price went up. House price was 10 rupees. You took a 12.5 rupee mortgage, right? And the bank financed you 10 rupees. Now, when you lost 2.5 rupees, what the bank did, bank came after and seized your property. Bank got its 10 rupees. You lost your savings, entire savings. This is what, ordinary people need to be protected against. Now, here, the thing is, we are giving unsecured loans. The guy defaults, what will happen? When you do the people who take this risk are these lenders, not the borrowers. Unlike, in a secured loan, the borrower loses. Do you see what is happening? Now tell me, look at the irony of the situation, right? The single biggest segment which is growing fastest in India is gold loans.
And that's a huge worry.
Worry is fine, but RBI is not clamping down. Who is taking risk in gold loans? It's the poor guy.
Borrower. Yeah, the guy.
Lender has no risk. Lender has absolutely no risk, because I know that I can sell off your gold. In fact, I find in the data, that when the borrower is evolved, this whole idea of evergreening, you said RBI is risk averse, right? What I can see in the data, they are not seeing. You know, Gold loans, when you're on the verge of default, the lender gives another loan. They have this is what happens in the data. In 20% of the cases, I see that lender gives another loan. You know why? Because lender knows I give you another loan. I can give you as many loans as long as you are close to that gold ka value, because I know that it's coming. So gold loan is where, if you're really concerned about the poor, you should migrate them from gold loan to unsecured loan. Unsecured loan, the people who are losing out are these fintechs, not the poor. Because you can't, the one good thing is, because our court system is so bad, you can never recover unsecured loan by filing a case. That's, you can forget, right? So unsecured loan is not that problematic. Of course, you should prevent high-handed practices using third party, these rowdies going, and those, if you can prevent, then the lenders know it. If they don't like it, they won't lend it. That's why I'm saying, do an RCT.
So, my last question to you is again coming back to the same thing. In an ideal world, how would we balance regulation and innovation? Supposing you have done the experiment and we have some sort of a result. So, what kind of regulatory framework is needed to ensure a safe, transparent, and an innovative use of AI in which both the user and the fintech and the regulator, in this case the RBI, know that everything, know what's going on, because AI by itself is an opaque creature, if it's a creature.
Yeah. So that's why, I'll take you to one wonderful paper by Vikrant Vig, Amit Seru, and others, published in the QJE in 2008. They have this, what they do is, the 620 credit score apparently is the cutoff in the US. Above 620, below 620. If you are above 620, you get a loan. Now, when in the height of global financial, when in that madness, when everybody was getting credit, it's before global financial crisis. So what they did was, they took a sample of people at 620, just above 620, and just below 620. Those who have loans. Ideally, those who have loans just above 620 and below 620, there should be no difference in default rate. 620 is a random number. What they find is, above 620, default rate is massively higher. What people have done is that, because 620 score is, nobody will ask questions if I lend to people above 620. I have got all kinds of bad people, which I know that bad, but somehow credit score has not picked up, and lent at 620. So I'm saying, as a regulator, you have to be checking algorithm. There is no other substitute for vigilance. You can't just say, I'm conservative, I don't want to take risks. Check the algorithm, do these kind of tests, have these kind of people who can do these tests in your in your team, and keep looking at this algorithm. Look for moment you find, let's say, an abnormally high credit growth. Don't clamp down on lending at that time. See whether something abnormal like this is going on. Look for data, because if they are using AI, you also use AI.
So, sorry to interrupt you here.
Yeah.
So, just so we are clear, the RBI doesn't have a whole bunch of scientists like you and a lot of tech guys sitting and looking at any AI to regulate them, right? So, how
They
will
do
this?
have-
They need to hire.
no, to their credit, right now they have two institutions. One is CAFRAL, which has a bunch of very good economists, who are capable of doing all of this, who are with RBI, and then they have also started RBI Innovation Hub in Bangalore. They are also industry professionals, good people, high quality people are there. I think they should. I think with that, if they scale these two up, I think they should be able to do it. Constant vigilance. All that I'm saying is, a summary number should not be a basis for clamping down on anyone. Go deeper. It should be a starting of a sort of deep analysis. So vigilance. My answer, one line, one word answer you want is continuous vigilance. And don't create algorithms which you don't understand. That's another thing that they've suggested. Try to continuously keep looking at algorithms, looking at practices, understand from 2008 research, think how do forms actually manipulate, look for these signs. I think that's the best you can hope for, because eventually wherever there is debt, there will be crisis. You can't do anything. Debt is something like that, because we sort of think that debt is depositors tend to believe that they have a risk free instrument, which is not risk free, and somebody has to bail them out eventually. So that you can't prevent as long as the system is debt driven and not equity driven, you will have all kinds of crises. But at least you can avoid before. But it should not be based on some NBFC lent at annualized 40%, so let me shut it down. Those kind of things are bad.
Okay, thank you so much for joining me today. I hope our listeners had a better understanding of what in the world fintechs do and how AI plays an important role and the kind of role it plays in deciding how fintechs work. Thank you so much, Professor Tantri, for joining us today.
In Focus will be back soon with analysis of the biggest news issues. In the meantime, you can find our podcast on Spotify, Apple Podcasts, Stitcher, and other platforms. Just search for In Focus by The Hindu. We'll see you soon.